Stock market has performed well in the first quarter so far in 2024. Will the momentum continue? How long will the Fed hold on to the present high interest rates? Hello and welcome to this Cedar River Capital Market Touchstones slideshow update for the first quarter of 2024. The date today is March 20th, 2024, and today we'll be discussing these and other factors driving the stock and bond markets. My name is Paul Latta, and I'll be doing the speaking today, but my business partner Baj Kochar and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. We'll begin today with a discussion about the recent market action. Then we'll look at the macroeconomy to put some backing behind the markets. Then we move into a microeconomic view and look at key industry-specific drivers, and then we'll conclude with a couple slides on longer-term observations about the investment landscape. The S&P 500 has done well over the last 5 years, up 96.4% through March 18th. It broke through a new high just this quarter. Year to date through March 18th, we're up a little over 8%. The bond market had a very tough year back in 2022 and has since been in a bit of a trading range. Bond market performance is strongly tied to interest rates, of course, so the Federal Reserve's interest rate hiking campaign has been especially tough on the bond market. A more dovish Fed would certainly be welcome, but the Fed's higher for longer mantra has kept the bond market from mounting a meaningful recovery. The Fed's rate hiking campaign raised overnight Fed funds to the highest level in over 20 years. But the last hike was in July of last year, and at subsequent Fed meetings in recent months, the Fed has elected to not raise rates any further. We're now in a bit of a holding pattern, though that could change in coming months with possible rate cuts. Here we see the implied probabilities of Federal Reserve rate cuts at future Fed meetings. These probabilities are based on Fed funds futures. As shown in the blue squares, the most likely scenario is that the Fed will make its first rate cut either at the June 12th meeting or the July 31st meeting. Might mention that we just had the March 20th meeting, which shows in the blue square at 99%. I think we now know that's a 100%. The rate probabilities, of course, are a moving target, and they change every day based on commentary from the Fed, as well as economic data such as consumer price index, inflation, or unemployment, and much more. In our slideshow last quarter, the Fed funds futures were implying 5 rate cuts in 2024, not the 3 cuts that we're seeing here today. So 2024 has been a little bit less dovish than expected at the end of last year. Lower inflation will be the driver for rate cuts. Short-term rates remain higher than long-term rates, partly reflecting the consensus that the Fed will be cutting rates in the coming months. It's unusual for short-term rates to be higher than long-term rates. Usually investors get paid more for a longer-term commitment. But as you can see here in green, short-term rates on the left side of this chart are about 1/2 to 3/4 of a point higher than the long-term rates on the right side of the chart. The unusual yield inversion has been with us for nearly 2 years and is a fixation of the financial media since yield curve inversions over the last 50 years have been consistent recession indicators. At this point, there is no sign of recession in the US, though there are overseas economies with inverted yield curves, and they are seeing economic weakness. We'll chat more about the economy on slides 18 through 21. The Fed paused its rate hiking campaign in July of last year, and most other central banks around the world also moved into a pause mode. Inflation is declining in most regions of the world, though inflation levels are generally still above target. Switzerland is likely to be the first central bank in the developed world to cut rates as inflation is now below their 2% target. Japan remains an outlier, mainly due to historic deflation over prior decades, and in fact, Japan just exited negative rates. Back to the stock market. Bulls and bears have differing opinions on a handful of points, as you can see here. Top on the list is the Fed and central banks. Bulls are enthused about prospects for rate cuts in 2024, as we saw on slide 6. But bears would note that even with 3 rate cuts in 2024, the rates will still be high compared to historic norms over the last 20 years. And the Fed is dragging its feet with a higher for longer mantra, knowing how hard it is to lower inflation. Bulls would highlight that the artificial intelligence story driving big tech is early and likely to see growth for perhaps another decade. Bears would not dispute that we are in the early innings, but instead would point out that investors typically buy the rumor and sell the news, and the rumor phase is about over. Bulls would highlight that valuations are somewhat above average levels, but are still within historic ranges. Bears would point out that valuations are high relative to rates available on bonds and money markets, making stocks less attractive. Bulls would highlight that money on the sidelines in money markets is at record levels, and that creates future buying power when that money comes off the sidelines. Bears would not dispute this, but with a yield curve inversion likely to pressure the economy at some point, the money is likely to stay on the sidelines and perhaps even increase. Lastly, bulls will highlight the unexpected positive surprises in the stock market related to ingenuity, innovation, and invention. We've seen this with innovations in artificial intelligence, genomics, and electric cars. Bears, however, will highlight the unexpected negative surprises of war, geopolitics, and acts of God. We've seen this in Ukraine, South China Sea, and Israel. Also, this is a presidential election year, which creates uncertainty. We'll chat a bit more detail on subsequent 4 slides. Money on the sidelines has increased, as you can see in the chart here. We now have cash equivalents of nearly $9 trillion. Higher rates have been a key driver. Certainly higher rates are more attractive to savers, but also the yield curve inversion and the related recession threat. Cash is actually a safer vehicle than nearly all other asset classes. Eventually rates will decline, as we discussed in slide 6. In past periods of peak cash levels like 2008, 2003, and 1991, the stock market rallied strong in subsequent years. Is the artificial intelligence story still fresh from the perspective of investors? At present, the answer is clearly yes, but for how much longer? Bulls will point out that NVIDIA, the single biggest beneficiary of artificial intelligence, has seen its stock rally over 200% since the introduction of ChatGPT. But NVIDIA's earnings have lifted even higher than 200%, meaning the PE-based valuation is actually lower. Bears would point out that the AI-driven stock market rally is really all about one stock and one stock only, NVIDIA. Sure, the cloud companies are seeing modest boost to growth, Microsoft, Amazon, Google, and they are devoting resources aplenty, but so far, only one company has seen truly triple-digit gains. Bulls would highlight that AI will proliferate across many consumer and technology-oriented companies in a way that will not segment or isolate the artificial intelligence impact. It's a tailwind for overall society and the stock market. Bears would not disagree, but would point out the very difficult comparisons, especially for NVIDIA as we near the back half of the calendar year. Shrinking growth will eventually be a headwind. Bulls will point out that generative AI technologies like ChatGPT are transformational for society, not unlike the internet of the 1990s. Nearly every company in the S&P 500 will be touched in some way by artificial intelligence. Bears, however, point out that, like the internet of the late 1990s, investors will sell as the technology matures, hearkening back to the age-old maxim, buy on rumor, sell on news. Bulls will point out that AI investments will continue for years. Gartner is showing a $2 trillion market in spending by the year 2030. Bears will highlight the risks of untested AI, including misuse, bias, and the risk of factual errors. The market valuation is modestly above the middle of its historic range. This chart shows the last 10 years of the S&P 500 in blue and the PE ratio of the S&P 500 in purple. As you can see, the S&P gained 238% over the last 10 years. In purple, you can see the price to earnings ratio has ranged from 14 to 23 over the last 10 years and is presently at 20.6, which is above the middle of the historic range but below the high end of the range. Stock and bond valuations have converged substantially. The chart here compares the earnings yield on the S&P 500 to the yield on the benchmark 10-year Treasury bond. Whichever line is higher is the better value with this approach. As you can see, stocks remain the better value, but the higher rate environment has narrowed the lead considerably. We have been buying bonds in the last year, reflecting the more reasonable bond market setup. Investment returns by sector so far this year show that the technology and communications sectors are leading. Note, these are the sectors that have been driven by the sizable gains in NVIDIA and Meta platforms. The real estate and utility sectors are lagging so far year to date. Both sectors are dividend oriented and hence have a hard time drawing investor inflows when money markets are over 5%. The style factor breakdown in the first quarter of the year so far has a few quirky results. First, momentum has been the dominant style factor so far in the first quarter of 2024, and the lead is not small at over twice the S&P 500 gain. Seems that AI-driven tech names of 2023 continue to gain outsized inflows relative to the other styles in 2024. Second, the momentum rally has been especially tough on dogs of the Dow investors betting on a reversion of the laggards in the early part of the year. Third, Momentum is typically associated with a market that rewards growth over value, and mainstream growth has indeed performed quite well, the third best style factor so far. But the more aggressive growth styles, story stocks, and high beta, were actually the worst style factors, barely squeaking above break even. So the roaring momentum market has resulted in a few uncharacteristic quirks to the style factor performance so far in 2024. The US market has been better than most of the rest of the world so far, up a little over 8% as of March 12th. A big driver was the momentum in the mega cap tech names on the artificial intelligence enthusiasm. A little surprising to see Europe not too far below the US at up 6.6%. Europe does have a smaller parallel rally in their own mega cap technology names, including ASML, Ferrari, SAP, and others. Some geographies are benefiting from inflation, Japan and Turkey, though for opposite reasons. Japan is actually welcoming inflation after 35 years of deflation. Turkey is certainly not welcoming inflation, but is using equities as a hedge against hyperinflation. China is seeing mixed performance depending on whether you're looking at the A shares, the H shares, or the N shares. Israel is seeing additional momentum after stocks rebounded after the Hamas attacks. Overall, despite a few pockets of weakness, global market performance is doing reasonably well. We'd now like to move on to part 2 of our slideshow today, the economy. We'll begin with looking at gross domestic product levels by country. In the top line at the right, you can see the U.S. GDP growth remained strong in the fourth quarter at 3.3%, a downtick from the very strong 4.9% in the third quarter, but strong compared to most other developed countries. Indeed, the U.S. economic strength, well, it's a bit of an outlier. Most other regions of the world were fairly weak, with GDP rates fairly close to zero. However, the weakness was less pronounced than it was in the third quarter. Indeed, we saw modest improvements in several formerly troubled countries like Canada, Japan, France, Norway, and South Africa. Still, there are several countries of size now in technical recession, 2 consecutive quarters of negative GDP growth. Germany, Sweden, and the UK. Also, Brazil is on the edge of technical recession, which likely explains why Brazil's central bank was one of the first to start cutting rates. Why is the US so strong? Arguably, the biggest factor is America's geographic isolation from geopolitical events, especially the Ukraine situation, but also the Israel-Hamas situation. Another factor, perhaps a lesser factor, is election-driven fiscal spending. Where is the U.S. economy headed for 2024? The street consensus is showing 1.9% growth, with more of that growth in the first half of the year. That would be consistent with what we discussed in the prior slide about election year spending. Inflation is indeed moderating in most countries, but not at the same rate. For the U.S., the Consumer Price Index peaked at 9.1% in June of 2022 and has since dropped to 3.2% as of February 2024. That's the most recent month for which CPI data is available. While the Consumer Price Index has dropped fairly consistently month to month, the decline has been a bit slower than consensus forecasts. Most other developed countries saw inflation peak in mid to late 2022 and drop to lower levels. But the present levels, ranging from 2.2% to 5.3%, are still generally above the 2% target, so most central banks remain in pause mode. 2 outlier countries here include Russia and China. Russia inflation mainly remains high due to the Ukraine war, and China inflation mainly remains low due to economic weakness. U.S. inflation of 3.2% remains above the 2% target, which begs the question, where are the price increases coming from? As you can see here, shelter costs in yellow remain the biggest component of inflation. Note here that shelter cost is not measured using home prices, but rather uses monthly equivalent rent. This acknowledges that most home buyers use mortgages and are not cash buyers. Our last topic on the economy, but this is an election year, so we have several slides on the 2024 elections. We used this slide last quarter, which gives a nice summary introduction of how the stock market performs in an election year, as well as the year after elections. Average election year performance for the stock market is 11.6%, and the year after the elections, well, average performance is 10.7%. Both of the figures are not too far away from the average annual stock market return over the last 100 years of 10.6%. But as you can see, there is profound variability from election to election. This, of course, reflects the fact that the stock market is about more than who is president. It's also about things like global pandemics, Fed policy, subprime crises, wars, new technology, fashion changes, and hundreds of other factors. We borrowed this chart from our friends at Strategas, who point out that not all elections are alike. The market performs much better in a re-election than it does in an open election, and by a fairly wide margin, nearly 13 percentage points going back to 1960. Why would this be? This might be due to reduced uncertainty associated with a re-election, or it could be due to the complacency of a lame duck president during an open election. Statisticians are a little bit cautious here since, well, there haven't been that many open elections going back to 1960, and some of the bigger stock market drops, such as the subprime crisis of 2008 or the dot-com bust of 2000, well, they just happen to coincide with open elections. Regardless, we do have a re-election situation, and the market gains so far this year are off to a strong start. With more certainty about the candidates for president, we have again attempted to compile a street consensus of which sectors ought to do well under which president. The consensus is still evolving, of course, but it seems the most consistent sector bias at present is big tech being Democrat and big oil being Republican. This does not mean Democrats will skirt or avoid big tech issues on antitrust or tax changes, or Republicans will quickly drill various wildlife refuges. Other consensus Democrat biases seem to be in favor of renewables, electric vehicles, and to a lesser extent Mexico. Other consensus Republican biases include banks, defense, firearms, and Russia. The Russia bias, of course, is more of a statement about the bias in favor of oil rather than a statement about the war in the Ukraine. Notably, some issues that were formerly divisive have become bipartisan. China's at the top of the list there. Immigration seems to be headed that way, and of course, budget issues will always be contentious. The exchange-traded fund, or ETF, industry has risen to address the need for specific funds that represent either Democrat stocks or Republican stocks. So far in 2024, the Democrat ETFs are leading. Of course, the leadership is more a function of the tech bias of the Democrat ETFs and is certainly not to be used as an election predictor. Notably, the 4 ETFs here are based on 2 different methodologies. The MAGA and the DEMS ETFs, MAGA and DEMZ, those are based on political contributions from public companies. In contrast, Nancy, NANC, and Cruz, KRUZ, well, those ETFs are based on what stocks are owned by congressional leaders of both parties. A little curious that big tech dominates both Democrat ETFs, but big oil has very little presence in the 2 Republican ETFs. The Republican ETFs are more diversified and have quite a few small banks, but very few large banks. We'd now like to move on to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at the handful of industry-specific factors that are shaping overall capital markets. We're going to highlight 5 industry discussion topics today, beginning with the Magnificent Seven. Are they now going separate ways? Boeing stock turbulence. Is something broken here? The electric vehicle slowdown. Is this a cyclical slowdown or structural? What about those chip stock inflows? Can we reconcile those with the fundamentals? What's happening with the softness in natural gas prices? Have we decoupled from oil completely? The Magnificent Seven stocks all rallied hard in 2023, even earning them the nickname the Magnificent Seven. But so far in 2024, this band of megacaps has been anything but uniform. Indeed, we have 2 names that remain rocket ships, 3 names that are, well, not too bad, and then the last 2 that are underwater and don't really seem set up for imminent recovery. The biggest rocket ship of the year has clearly been NVIDIA. Indeed, as we discussed back on slide 11, NVIDIA has been the embodiment of the AI story. Every software developer doing AI apps must run on hardware using NVIDIA's GPU chips. Meta has also done quite well, though not due to profound growth, but rather due to severe undervaluation after the 2022 threat on the Apple privacy changes. While the threat remains, the valuation is still cheap compared to the other Magnificent Seven peers. In the middle, we have Amazon, Microsoft, and Google, and all are still benefiting from generative AI apps, but is driving more mid-teens growth, not the triple-digit growth of NVIDIA, and we've seen similar growth in share price. Apple, however, has seen very little AI benefit due to a smaller cloud business. Let's face it, most of the AI business takes place in the cloud. Also, the new iPhones and other devices are just not seen as breakthrough at this point. In the basement, we have Tesla. That's seeing the most pressure, and that's reflecting a combination of high interest rates, possible loss of tax credits, price cuts, and related margin compression. Anyway, so far in 2024, the band of megacaps known as the Magnificent Seven has been anything but uniform. The Magnificent Seven label has only been around for about 2 years, but big tech has seen an evolution of the various labels to encapsulate the popular names over the last decade, beginning in 2014 with the original FANG acronym: Facebook, Amazon, Netflix, Google. Disruptive growth is the norm in the tech sector, so performance deviations, well, they should be expected. We're likely to see another label manifest in 2024. Boeing stock has been in the headlines quite a bit in recent months. Most of the headlines were related to manufacturing issues with its fuselage supplier, Spirit Aerosystems. The vertical fin issue in April last year was digested by investors as an isolated incident. Investors were again fairly calm with the aft bulkhead issue in August, but the door plug blowout in January of this year, many investors cried uncle and sold the stock. The FAA then deepened its involvement, grounding 737 MAX 9s and capping Boeing's ability to expand production. As you can see in the chart here, Boeing stock tracked its closest peer, Airbus, fairly close over last year, but at the beginning of 2024, Boeing severely underperformed Airbus, down 27% year-to-date versus Airbus up 13% year-to-date. Where is Boeing stock headed from here? The company clearly has near-term challenges, but long-term prospects are intriguing. In the near term, earnings estimates are clearly at risk, mainly due to production and process changes, though the delivery schedule also has some risk. Note, we have already seen Southwest Airlines cut earnings estimates due to inability to add to its fleet. Boeing has usually traded at a modest PE premium to Airbus, though in 2026 earnings, the stocks are trading at about equal. It is unclear if Boeing will reclaim its premium, given the headlines around the Spirit problems. Indeed, another manufacturing problem would not be well received by investors and other stakeholders. However, longer term, today's manufacturing issues could well be forgotten. Boeing is still retaining its 2025 and 2026 earnings and production targets, and while market share loss to Airbus may seem like a serious threat, the reality is that Airbus has a full order book, meaning years for delivery. Since many of the recent challenges have all manifested from Spirit, Boeing could acquire Spirit to gain better control over quality issues. Boeing valuation at 18 times fiscal 26 price to earnings is a tiny premium to the market for a company regarded as a quality business prior to the Spirit challenges. And while the news is presently fixated on Boeing challenges, the news cycle will eventually move on to more important topics: presidential elections, geopolitics, natural disasters, etc. Changing topics to the electric vehicle slowdown, nearly all electric vehicle stocks have come under pressure recently, and yet most legacy automakers are trading near recent highs. The electric vehicle stocks on the left half of this slide are showing the blue triangles on the left side of their 52-week trading range bar, but the legacy automakers on the right half of this slide are showing the blue triangles on the right side of their 52-week trading range bar. Here we can see the sales forecasts for the electric vehicle companies. Well, they keep getting revised downward. Yet the sales forecasts for the legacy automakers are holding up quite well. Why the weakness specifically in electric vehicles? Electric vehicle stocks are in a shakeout phase, separating the weak from the strong. Biggest challenge when looking at electric vehicle stocks is, well, there are actually just too many new publicly traded electric vehicle companies brought to market in the IPO and SPAC frenzy of 2020 to 2022. Not every electric vehicle company can be the next Tesla. Other headwinds include high interest rate environment, which has made auto loans challenging, possible losses and uncertainty over tax credits, price cuts and margin compression, and increased share of plug-in hybrids stealing share from the battery electric vehicles. While the shakeout may last some time, there are still positive investment attributes longer term. Valuations are certainly cheaper with the lower stock prices. Electric vehicle penetration remains low at only 7.6% of new vehicle sales in the US. Internal combustion vehicles are likely to see increased regulations over emissions, and new electric vehicle technology will likely be forthcoming on longer range batteries and possible robotics. Also, new models are likely to broaden appeal to a bigger audience. So again, the shakeout may last some time, but there are still positive investment attributes longer term. Changing topics over to chip stocks. Chip stocks have seen strong market inflows in recent months. Indeed, the semiconductor index, the SOX, is up 37% in the last 6 months, more than double the 15.9% gain of the S&P 500. Why is that? Well, much of the rally in chip stocks, broadly speaking, has been related directly or indirectly to NVIDIA. We're seeing inflows in broad tech ETFs as a backdoor way to own NVIDIA. Similarly, the momentum and growth style factor ETFs have also done well, partly as a backdoor way to own NVIDIA. Some investors are buying other chip stocks that might be the next NVIDIA, and many chip stocks pitch themselves as AI stocks, drawing investor inflows, whether or not the AI play is really material. But have the fundamentals in chip stocks really matched the inflows? Outside of NVIDIA, we are skeptical of the moves in most of the other chip stocks. NVIDIA grew earnings an astounding 455% in 2023, and those blockbuster earnings keep getting revised higher. Wall Street is persistently not optimistic enough on NVIDIA, even after a sizable run in the stock. But the NVIDIA story appears to be an isolated one-off situation in the chip industry. Indeed, the average chip stock in the semiconductor industry is not growing, nor is it seeing any upward revisions. Yet the average chip stock, excluding NVIDIA, gained 36.7% in the last 6 months. There are a handful of exceptions, such as Broadcom and ASML, but for the group as a whole, it would seem caution is warranted as expectations have risen, but without the support of improved fundamentals. Moving on to the topic of the recent softness in natural gas prices. Actually, both oil and gas prices have dropped from their highs when Russia invaded Ukraine. However, in recent months, natural gas prices, the chart on the left, have dropped like a stone, whereas oil prices, the chart on the right, have been in more of a trading range with not much movement. What's happening with natural gas, and will there be a reconciliation with oil? This chart looks at the ratio of crude oil prices to natural gas prices, and it shows the ratio is near a record high. Some investors do not regard this ratio as especially meaningful since natural gas is not as easy to ship globally as oil, so it's not uncommon for natural gas prices to see wide differences in the price of natural gas in Japan versus natural gas in Germany versus natural gas in Australia. Oil, in contrast, tends to see roughly the same price everywhere in the world at any given time. Still, when prices get bent out of shape too far, and it appears we have that situation now with the record ratio, that will push back to drilling behavior, increasing or decreasing supply as needed for the price environment. There's three main reasons for the elevated oil to natural gas price ratio. First, oil is a tad elevated due to tensions in Israel. Second, natural gas is near record production at present. And third, and arguably the most important, well, we've actually had a warm winter, and so inventories are running about 15% above normal. How long will the natural gas depression last? Well, it seems likely to revert over the next year. Indeed, we're already seeing natural gas producers announce production curtailments: Chesapeake, Antero, Comstock, EQ2, and a few others. Also, summer weather is more likely to be warmer than average rather than cooler than average, so it seems likely we will see a reversion in natural gas prices over the next year. We'd like to conclude our slideshow with two additional slides with a top-down and longer-term view. Over time, markets go up more than they go down. Over the last 60 years, the S&P 500 has gained approximately 10.5% per year on average, but variability in any given year is actually quite significant. The average bull market lasted 51.9 months and gained 151.6%. This is going back to 1960. The average bear market during that period lasted 11.1 months and lost 34.2%. Up years are more common than down years. Timing the market can be costly. This chart here shows the S&P return from January 2003 to December 2022, a 20-year period of time, and that if you put $10,000 in the S&P 500 back in almost 20 years ago, January 2003, it would have appreciated to $64,844. But if you missed the 10 best days during that 20-year period of time, your return would have been cut by more than 50%, down to $29,708. Also, it's interesting that 7 of the 10 best days took place in bear markets. In fact, big moves are commonly associated with market reversals. That's a fairly big headwind for the momentum style of investing, which of course has been the hot investment style year to date. Very challenging investment style to invest in on a longer term basis. And in fact, the takeaway here is really that time in the market usually beats market timing. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.